Hi, and welcome to the Market Alert for Friday, the 23rd of January 2015. And here in the chart you can see the market's reaction to Draghi's announcement that the Eurozone, we're not going to print 50 billion euros per month, but actually 60 billion per month. So that's just under $750 billion for the next year in funny money going into the Eurozone. It's not real money, it is bonds. And it is all it's doing is creating debt for generations to come in order to pay back. That is, of course, unless it collapses in the meantime. So we see the market's reaction. It moves higher initially, and then we see the market come back to where it more or less started before the announcements. And then we see the market moving lower. This is a shakeout. This is to wrong foot the novice trader, get them to go short. You see the buying coming in at 17,500, buying pressure here, and then the market turning around and moving back to the upside. All QE money has only sent the market in one direction, and that is to the upside, because that's where it ends up, and that's where all the bonuses are paid to the bankers. The money is not being fed through to the general public, which of course is what caused the problem in 2007, so they're not going to do that. So the 1% are finding their wealth increase incredibly as a result of this, and anybody who's sitting on stocks and things are seeing the values increase on a daily basis. So we've got this massive bubble, asset bubble, biggest in history, and all Fed and central bank funded. So we have a potential sell signal later on in the session, but this is going against the QE pattern of the market moving higher. So it's a risk to go to the short side, especially on a day when 60 billion a month is going to be printed. So this is why this signal failed. It's a 38-point loss had you have taken this one. The long side is then given here just at 18:30, early part of the evening, and we see the market moving higher. I'll just mark this one up for you and see the market trading. Market trades up to 17,700, fails to close below this. Again, take note of the psychological levels when you're in the trade. Even though the market traded below, within the next 5 minutes the market traded above this, and then once we drove through, the market continued. And if you look at part 2 of the manual, trailing the stop, once the market closes above the 20-point scalp, and there's days when you can do this, and yesterday is one of those days, because again, it's a given. The market will always go up following any form of QE, because that's where the money ends up. So trailing the stop below all of the rising lows as per the instructions in the manual and also in the videos in the additional training section of the website, you can see that the market didn't come anywhere near until we got to this point here, 17,813. But look how close we actually got to 17,850 as well. The high in this market was in this bar here. We'll just click that, which was 17,843, 7 points off. But also notice the resistance here as well at 17,839. This happened 3 times before the market started to break out of it and the selling came into the market. So here around 127 points in this trade, with if you took the short trade earlier, less than 38, it's given around a 98 point profit on the day, including the potential loss there. In the daily charts, let's just cancel this. In the daily chart, you can see we marked up all of the resistance areas yesterday. The market drove through this, but there's a very important point to note in this chart, and that's that the volume for yesterday is not massive. This market has been marked up against the current sideways to lower pattern that we have at the moment. A bit of indecision on the overnight market as well. So it's quite possible that the market will head up towards 17,886, or it could in fact find support at 17,750, and also thirdly, could actually move lower today, as well as the market has become used to seeing the QE as well. A bit like a drug addict when the first injection of heroin puts them on an incredible high, which is what we saw in 2009 when QE first arrived on the market. But of course, whether it's alcohol or drugs or whatever, you tend to need more to get the same reaction or high, and that's what we're likely to see in this market. So I'd expect a sideways trading day today unless there's any significant news. Let's just have a look. 130, nothing at 130. We've got 245 medium impact. We've got the manufacturing PMI, and then we've got existing home sales as well, which forecast to come out slightly higher. So don't expect the same sort of move as we had yesterday. It could be fairly quiet in comparison. Finally, on the implied volatility front, down to 12.58. Big drop off yesterday off a cliff. The volatility needs to come back down in order to get the next move to the downside as well. So that's a big drop off yesterday, some 2.5% there. So again, this all indicating really a sort of sideways move from this point forward. Right, that's it for me for today and also for the week as we head into the weekend. As ever, thanks for your support, very much appreciated. I will see you in Monday's edition of the Market Alert. Have a great weekend, and as ever, thanks for watching.